Interest can be a powerful tool in your financial success, but we want to find out what it is and how these interest rates are determined. Corey Blake is here to help us with all of that. As always, Corey, let's start with the basic step one, numero uno. What is interest?
Okay, so basic terms, interest is the cost of borrowing money. If you borrow money, you will pay interest to the lender. If you save money, the bank will pay you interest. And we all like getting paid interest for sure.
Yes.
You'll see interest expressed as annual percentage rate, or APR, or you'll see it as annual percentage yield, which is APY.
And Corey, what's the difference between those two? Can you explain that a little bit further?
So the APR is the annual rate of interest your money will earn without taking into account any compounding of interest within that year. The APY is the annual rate of interest your money will earn in 1 year and does take into account the compounding interest. Now there's two things you need to remember. Simple interest is interest paid on principal, the original sum of money that you invested. Compound interest is better for saving because it allows you to earn interest not only on your initial deposit but also on that interest that accumulates. Compound interest is added to the principal automatically when it is paid, and the interest payments after that are figured on the whole sum plus principal interest.
All right, so one big thing I think a lot of people wonder is, how are these interest rates determined? For example, why is the home interest rate right now right about 3.625, something like that? How do they figure that out?
Well, actually the U.S. Federal Reserve raises and lowers the interest rates to maintain stability in the U.S. financial system. The Federal Reserve regularly takes action on interest rates in response to economic ups and downs. When interest rates are high, you earn more interest on your deposits, but you also pay higher interest rates on any money that you borrow. Now, when interest rates fall, you earn less interest on your savings, but it costs less to borrow money. Some institutions pay more interest on higher balances to reward account holders who have higher savings accounts. And credit unions, because they don't have investors they have to pay, typically give a higher rate on savings to their members. Now, this is one of the advantages of obviously being part of a credit union.
And I'm sure if people want to find out more of those advantages, they can get in contact with you and your friends over at New Horizons. Thank you so much for this insight into interest. It was interesting.
I'm glad you're interested, and I hope they were too.
All right, good times. Thanks a lot, Corey.
Thank you.